many people take a look at a chart like this and think, wow, the price of gold is up 37 times versus where it was 45 years ago. Now would be a good time to take some profit. Or, wow, the price of gold is up 5 times over the past 15 years. Surely it's overbought at this point, and taking some profits off the table is the right thing to do. But this viewpoint presupposes that the risky position is being in gold, and the risk-free position is having the bank account flush with cash. I'm going to show in this video that it is gold that is the low-risk holding, and that it is paper that is the more risky of the two. I'll discuss the conditions under which paper might be a good speculation for increasing one's wealth, and I'll also discuss the condition under which silver may be a better holding than gold. Let's start out with the question of whether gold or the dollar is truly the low-risk asset. At the start of this 45-year period of gold price increases, we can see what 1 ounce of gold was able to purchase. It could purchase 10.4 barrels of oil, 18,600 first-class U.S. postage stamps, 0.012 years of tuition and board at Yale University, or 35 Federal Reserve notes. We can see that over this 45 years, which is the typical investment lifetime of the average person, the value of gold, as measured in Federal Reserve notes, appeared to march relentlessly higher to the point where an ounce of gold was worth $1,325 today. This appears to be a total increase of 3,685%, or 8.4% per year. But was this really an increase in the value of gold, or was it a decrease in the purchasing power of the dollar? Well, we can see that at the end of the period, an ounce of gold could buy 14.4 barrels of oil, which is only 29% more oil, but certainly not 37 times as much. It could also buy 45% more U.S. postage stamps and 75% more time at Yale University. So yes, gold increased in value over this time frame, but the gains that are apparent by looking at gold in terms of dollars are much more a reflection of the depreciation of the dollar. So as a long-term holding, gold is certainly safer than the dollar, which puts into doubt the whole notion of the dollar being the riskless position. Let's turn this chart on its head so that gold, as the safer of the two positions, appears in the denominator. Let's measure the strength of the dollar against gold instead of the other way around. There we go. Now we can see what the value of $1,000 in Federal Reserve notes has done in terms of gold over the past 45 years. It started out at about 28 ounces of gold, but after 45 years would only purchase about 3/4 of an ounce of gold. Clearly for the saver, whose primary interest is in preserving purchasing power, cash is a very risky place to be in the long term. But wait, you say, nobody ever proposed holding just cash. You forget about the interest that it can generate if it's lent out. Treasury bills are truly the risk-free place to be. At least that's what Wall Street proposes to be the risk-free asset. Okay, let's look at that. Let's see what would have happened if in 1970 a person put $1,000 in Treasury bills, collected interest, and kept rolling the cash over into new Treasury bills over this 45-year period. The red line shows what would have happened to the investor's wealth as measured in gold over the 45 years. At the end of the 45-year period, even with interest collected, the investor would have ended up with a pile of cash that could only purchase 10 ounces of gold instead of the 28 he could have started with. To make matters worse, the investor probably would have paid taxes on every dollar of interest over this period. The green line reflects the impact that the taxes would have had. At the end of this period, the investor who paid taxes on his T-bill interest would have been able to buy only 4 ounces of gold. In other words, the investor would have lost 85% of his total wealth in what Wall Street touts the risk-free asset. It doesn't seem very low risk to me. And yes, the investor could probably have done much better by placing the money into long-term bonds or even stocks, but doing so carries with it much greater levels of risk. Besides, long-term bonds have historically only returned a couple of percentage points more in interest than T-bills anyway, which, as we'll see later, is not very important after taxes are taken into account. Let's focus for now on vehicles that are appropriate for someone who's interested in saving, not speculating. Now, the period from 1980 to 2000 is always cited as the reason why gold is risky and should be avoided. During those 2 decades, the price of gold in dollars declined at the same time that the price of most goods and services increased. By contrast, the years from 1980 to 2000 was a great period of time to be in treasury bills and all other paper assets for that matter. In all other periods of time, gold was the better place to be, long term. This would indicate that the gold holder can potentially profit by selling gold and moving into shorter-term treasuries at the right times. This selling of gold and purchasing of treasuries can be viewed as speculative because the investor is buying a more risky asset in the hopes of generating profit. There are metrics that can be used to judge when engaging in such speculation is wise. Let's investigate what it was about the 1980s through 2000 that made paper investments a good speculation. So let's explore what made this period of time more favorable for T-bills for building wealth than just holding gold. Well, there are two effects that need to be considered. One is the valuation of gold relative to other stuff, and the other is the level of interest rates offered on paper. Let's explore the former by using one of my favorite gold valuation graphs, the value of gold relative to oil. For 45 years, one ounce of gold has purchased anywhere from 10 barrels of oil to about 25. When it's close to the top half of this range, it's a pretty good indication that gold is fairly expensive relative to other stuff. Now, I'll have to interject here that I'm talking about gold valued as a commodity. If gold regains its role as money, its value is likely to greatly exceed this range. But since gold has been valued as a commodity for 45 years, we'll just use the valuation shown on this graph. So we can see here that in the late 80s and all throughout the 90s, gold was fairly expensive relative to oil. So gold may not have been the best choice for preserving purchasing power during this period of time. Other tangible goods, such as real estate, may have been the better choice. So one benefit that T-bills had during this time period was that by being in them, one could have avoided the downward revaluation in gold. In the 80s, the interest rate on T-bills was also historically very high. So the person who sold some gold and bought T-bills also benefited from the income generated by the T-bills. Both effects combined explains why T-bills appeared to be superior to gold in the 80s and 90s. We can look at the data as a whole and determine generally when T-bills might be a good speculation. Let's do some statistics. Here are some summary statistics that can help us draw some useful conclusions. I've plotted how a 2-year cash holding has fared against gold based solely upon gold's valuation relative to oil at any given point in time. If you're not statistically savvy, don't let the appearance of the graph intimidate you. It's really just a simple graphical representation in statistics called box and whiskers diagrams. It displays for a given set of data where the first 25%, second 25%, third 25%, and fourth 25% of the data are located. For example, if we consider the set of data where gold bought less than 10 barrels of oil, we can see that 25% of the time cash has lost purchasing power relative to gold to the tune of between 36% per year and 25% per year. 25% of the time it lost between 25% and 20% per year relative to gold. 25% of the time it lost a little bit less than that, and the final 25% of the time it lost between 15% and 7% per year relative to gold. 50% of the data is shown as a box, with a line in the middle of it showing the median, or middle point of the dataset. The extreme ends of 25% each are shown as lines, or whiskers. It's pretty simple stuff, really. Oh, and that black dot in the center? That's just the average rate of return. What we can see from the entire graph as a whole is a general trend where cash is much less likely to do well relative to gold when gold is cheap, and much more likely to do well when gold is expensive. No surprises here. When gold bought less than 10 barrels of oil, there was not a single instance when cash performed better than gold over the following 2 years. Moving over to the right, we can see that when gold bought between 10 to 15 barrels of oil, cash did better than gold only about 25% of the time. But for the other 75% of the time, gold performed much better. Moving again over to the right, we can see that it wasn't until gold was valued at between $15 to $20 a barrel that both cash and gold had a roughly equal probability of doing well over the subsequent 2 years. Moving to the far right, we can see that it's really not until gold rises above 25 barrels per ounce that cash is an almost sure bet. When gold was valued this highly, cash performed better almost 75% of the time, even in the absence of interest income, simply because gold was highly valued and likely to correct. If we want to include the impact of interest, all we need to do is take the numbers shown on the box in Whiskers charts and move them upward by the interest rate. For example, in the early 80s, we had gold valued between 10 and 15 barrels per ounce, which would mean that cash would more often than not be a bad bet. But add to that the interest rate at the time, which was about 14%, and you can see how the odds would start to favor a speculation in T-bills. So a high interest rate can take what would be a losing proposition and turn it into the potential for gains. This works in a moderate interest rate environment as well. Consider the 90s, when gold was valued between 20 to 25 barrels per ounce. Absent interest income, cash would be a winner only about half of the time versus gold. But when the interest rate is 6%, we can see that it increases the odds of paper doing better than gold by up to about 75%. Sorry about all these statistics, but really the art of speculation is all about probability and statistics. And so, we have to get a little bit in here. Can we turn this into a general rule where you can evaluate the merits of paper versus gold for various interest rates in gold valuations? Sure. Let's see how we can do that. Here I've taken the data from the previous slide and calculated the interest rate that would be required to raise the 50 and 75% points on the box and whiskers plots to 0. I fit curves to the data points to allow some interpolation for various gold valuations. You don't need to worry about the formulas. You can just use the fitted curves if you like. The significance of the red line is that it is the minimum interest rate that will be needed to give you a 50-50 chance of a T-bill outperforming gold for a given gold to oil ratio. Anywhere below this curve, and the odds of doing well in T-bills are less than 50%, and so owning paper in place of gold won't make much sense. The green line is the interest rate at which you will have a 75% chance of the T-bill performing better than gold, either because of the income, because of gold's high valuation, or a combination of both. Interest rates above the green curve will be highly favorable to T-bills versus gold in terms of odds. In between the two curves, it's more of a crapshoot. The odds will favor paper slightly, but as I'll show you later, the tax man will skew the odds back in favor of just owning gold. You can see from the blue dot where we are now. The gold to oil ratio is about 13.4, and the interest rate on T-bills is negligible, making T-bills the equivalent of cash. Historically, gold has been a better holding than paper about 75% of the time at this condition. Based upon this graph, we can generate a fairly straightforward trading rule. Anywhere below the red line, we'll just hold gold. Between the red and the green lines, we'll gradually increase our T-bill position until our T-bill to gold mix is 50-50. Above the green line, we'll just maintain the 50-50 gold and T-bill mix. Why do I limit the paper position to 50? Well, it's because the risk that we haven't talked about yet, and that is that paper will be discredited either through the devaluation or default and gold will be revalued as money. If this were to happen, then the cash position in the portfolio will lose almost all of its value relative to gold. It's never prudent to speculate with more than 50% of your wealth, and thus the limit. So with that, let's see how this trading rule would have worked out. We can see that in theory, the trading rule works out pretty well. Here I'm comparing the results against just holding gold as the baseline. There's a brief period of time early on when the trading rule results in some slight losses relative to just holding gold, but overall the strategy of selling some gold and taking a position in T-bills at the right time resulted in a doubling of real wealth over the 45 years, which isn't too bad. We can see that both the trading strategy as well as the strategy of just holding gold did better than simply holding T-bills the whole time, and much better than just holding cash. Okay, so we now have a formula that virtually guarantees a real profit, right? Well, not exactly. We've left out an important consideration, which is taxes. Let's add that effect and see what happens. It turns out that the taxman takes a considerable amount of the T-bill profits away. Instead of doubling our apparent wealth with the trading rule, we really only increase it relative to just holding gold by about 50%. This works out to be a little less than 1% per year rate of return. It would probably be even less when considering the bid-to-ask spreads on gold. It's not clear that risking up to half of your wealth at any point in time is worth such a small gain. If I told you to give me half of your wealth and I might be able to give you a return of 1% per year, but there was also a chance that you'd lose every penny that you give me, would you take that risk? Probably not. Of course, both approaches did better than just holding T-bills, which after taxes didn't even preserve their purchasing power for the holder. You're probably wondering why the baseline of just holding gold also gradually decreased over time. Well, I figured that it would make sense to include the tax effects of selling gold. Remember, when you sell gold, you'll generally have a gain in nominal dollars. If you hold the wrong kind of gold, then this gain will probably be reported to the IRS by your broker in the form of a 1099, which means that you'll have to pay taxes. The gently downward curving of the line for just holding gold is the impact that paying that tax on a gold holding will be at any point in time. I also took taxes upon liquidating gold to buy T-bills into account for the green line, just to make sure it was included as part of the trading strategy. The tax effect is very important for the saver to understand. As I'll show you in a second, ignoring the tax effect makes paper investments look even more favorable relative to gold than they really are. Gold has a very nice feature for the saver, and that is tax deferral. Let's see just how important this could be. Consider $1,000 placed in T-bills, shown as the blue curve, and $1,000 placed in gold, shown as the red curve. Both assets have been touted for their ability to preserve purchasing power over time. Let's assume that the rate of inflation going forward is 4% per year. Gold generally rises with the rate of inflation, and so let's assume that its nominal value also matches that 4% per year increase. I happen to believe that in the future gold will rise in real value, but for the sake of this illustration, we'll just assume that it preserves purchasing power, and nothing more. T-bills generally throw off an interest rate that's roughly equivalent to the rate of inflation. Let's further assume that you pay a marginal federal tax rate of 28%, which is also the equivalent to the capital gains rate that you'll pay on gold. If taxes were not considered, then both T-bills and gold in this mathematical exercise would behave exactly the same way. But taxes must be considered. They will be paid on the nominal gain in gold upon sale of the gold, assuming that the gains are reported to the IRS. Taxes will be paid on the T-bill interest as the interest is earned. We can see that for the first 5 years, the tax treatment doesn't really result in one saving vehicle being superior to the other. After 5 years, though, the curves start to diverge. But the most interesting part is the very long term. The most you can lose to taxes on a long-term holding in gold is 28%. Contrast that to T-bills, which continue to lose purchasing power until the purchasing power is lost almost completely. This is the real tragedy of paper investments. Returns on paper investments that are suitable for the saver are taxed as nominal gains, so the real gains to the investor are often zero or negative. You take all of the risk, and the taxman gets all of the benefits. But what about a strategy where the gold investor switches not from gold to paper, but from gold to a tangible asset that has a more favorable valuation, such as silver? Well, this is a very good strategy. It eliminates the risk of dollar devaluation and debt default, so you're not really putting your wealth completely at risk. If done right, you can also arrange for the gold to silver swap and back to be a trade, and thus it will not generate a 1099. I won't go through this chart in great detail, so if you're interested, you should probably hit pause and study it yourself. The main message is that silver has been a better performer than gold at a ratio of more than 60 to 1, and it's generally been a losing proposition at a ratio of less than 40 to 1. My personal strategy is to hold some silver at the higher ratios and trade it back for gold at the lower ratios. It's a strategy that works. You just have to be careful about costs because silver can be more expensive if you want to flip it. So in summary, gold has historically been a better investment than T-bills. There have been times when T-bills have performed better. Higher interest rates and higher gold valuations make T-bills more attractive as a speculation. The 80s and 90s were nothing more than a result of these factors. The trouble with T-bills is the almost taboo topic of currency devaluation and debt default. I can tell you with 100% certainty that one or the other or a combination of both lies ahead. I just can't tell you with certainty when exactly it will happen. Thus, any time wealth is stored in paper, you should consider that it is at risk. So when you choose to hold paper, you should be sure that the odds are in your favor and that you should never put at risk a portion of your wealth that is greater than what you can afford to lose. I generally think that the percentage of a person's investments allocated to gold should increase as retirement is approached. This is opposite of conventional wisdom, but given what I've presented in this video, I think it's a sound opinion. The other problem with T-bills is the continuous taxation of interest. Because the gains on paper investments are reported in nominal terms instead of in real terms, the value of a conservative paper investment is almost guaranteed to erode to zero over long periods of time. Gold, by contrast, is only taxed once upon sale, and if you hold the right kind of gold, there is no automatic generation of a 1099 form. Now, I'm not advising you not to pay your taxes. I'm only telling you what the rules are. Based upon current gold valuations and interest rates, I advocate a 0% T-bill position. Some silver may be appropriate. Speaking of silver, the data indicates that the odds favor silver outperforming gold when the gold to silver ratio is 60 or higher. The odds of favor gold over silver at a ratio less than 40. So you can tailor a trading rule to accelerate your wealth accumulation by trading gold and trading silver accordingly. Because of the volatility of silver, I prefer to keep my silver position small. Of course, you can choose any allocation you like depending on how much tolerance you have for large price swings, and you can do the same strategy for other metals, such as palladium and platinum. Silver has much higher spreads than gold, and so you should keep a close eye on transaction costs if you decide to trade back and forth. Silver is much better for this purpose than T-bills. It does not have the devaluation and default risk present in T-bills, and it's also a vehicle that enjoys deferred taxation. So the downside for silver, unlike T-bills, is limited, but the upside is pretty good. Well, I hope you enjoyed this video. Happy speculating, everyone.